reading 28, guys, this is more going to be in a function of how to build a model. So I'm going to run through this also very, very quickly because I want to get to the free cash flow, to the firm stuff, and the residual income stuff. So you can do top down, bottom, or a hybrid type of stuff. So top down, you're looking at a thing from a very, very high level. So I almost want to say, like, the way that you would do something like that is, instead of investing in a specific company, maybe it's more like a whole index. So if you think, because of this whole trade war, China's going to do badly, but you think India's going to do well, then obviously that's the way that you would do it from a thing. So you would look at macroeconomic factors based on maybe GDP growth and that type of thing, industry focus, and then eventually you end up on a company specific thing. So if you look at South Africa, you're going to try and estimate the GDP growth. One very good example of that, how you would, so the way that I do a fundamental analysis is from a bottom-up perspective, because I want to go into a very specific detail on a company. But when you look at a company like a cement company, you have to start at the GDP growth, because cement demand is driven by GDP growth factors. There's a multiplier effect on that. You can't, you're still going to do a bottom-up type of analysis, so it would probably be a hybrid approach. But the main thing is, if there's no GDP growth, you're not going to sell cement, or not too much cement anyway. Okay. Bottom up, top down, you guys kind of, bottom up is more like you want to estimate how many units you're going to sell, what's the margin you're going to sell, or what's the pricing you're going to sell it at. And then according to that, you're going to obviously estimate your top line. Okay. Then growth relative to GDP growth. So as I said, like the multiplier effect with cement, above a certain percentage, your I call it cement consumption in the economy is going to be like 2 to 2.5 times. Okay, at a certain point. So I think that breaking point is like 1% or something. And that's how we do it from this perspective. Okay, and then market growth and market share. The important thing that you need to understand is that if the market share of something is 100%, that's what everyone's got, 100%. Well, everyone added together has got 100%. So if your company has got 40% market share in something, if the entire market is growing and the price is maybe also growing a little bit, then your company will also be growing on the top line. Okay. If the market is stable, the only way for you to grow is either going to be through pricing, if we're talking about a volume perspective on the market share, either through pricing, so more pricing, or alternatively, taking market share away from someone. Okay. That's how that stuff works. So people always talk about the TAM, the total addressable market. So if the total addressable market is growing, great company to be in, tailwinds. Let me give an example. If you think about asset management, one sector that's very underpenetrated in the asset management industry is the passive industry in South Africa. So passive investments are growing quite quickly due to the fact that people are switching from active into passive. Okay. So the natural winner in that regard would be maybe a company like Signia. Okay. If you think about the active side, there's a bunch of companies that's on the active side. There's obviously a company that might be in a negative situation, or that would be a company like Coronation. So as you can, well, depends on how you look at it, but you could see that some of the assets under management has been declining a little bit for Coronation, whereas assets under management for Signia has been growing. That's just a natural way that the market share has been shifting in that thing. And there's a variety of other stuff that you can include in that side. Okay. Okay, economies of scale. Just basically, like, the more if you're growing your production or whatever you're doing, the unit cost tends to fall per unit. Why is that? Because you've got a fixed cost, and the more you push through the factory, the better. Because if your capacity utilization is high, then your unit cost tends to be lower because of the fixed cost component, not because of the variable cost component, the fixed cost component. Okay, so an example of that is a bakery. So if you have a Pioneer, you have this massive bakery that you built, and you want to push through as much bread as you can. If you're running that thing at 100%, you're making a lot more money than you're running that thing at 80%, because of that fixed cost component. Because if the fixed cost is a fixed cost, but if you've got more units that you're spreading it over, it's much, much better. The same with BHP Billiton with their mines. They're mining a lot of stuff, a lot of iron ore in Western Australia, and because of that, the more they can push through, the better from the unit cost perspective. Okay. That's the economies of scale. You can look through it from a common size financial statement. What is a common size financial statement? Balance sheet, you put the assets at 100% and everything else according to percentage of that. And the income statement, you put revenue at 100% and everything else as a percentage of your revenue. Okay, that's fine. Okay, then just how to forecast on a model. I know this is very theoretical. If you've done it before, then it's a lot easier. I would highly recommend that you do it at least once or twice if you haven't done it before. Okay, but how you would forecast something? Let's say you just look at something like a Tiger Brands or a Pioneer or a food producer of that of some sort. Okay, so you've got your revenue that you've already kind of estimated from a top-down or bottom-up perspective. So let's say bottom-up perspective, you've calculated how much they're going to do on revenue for bread and for groceries and for home and personal care and that type of stuff. And then you're looking at the gross cost of goods sold. How you're going to work this out is you're going to look at the history of the company, okay, and the different divisions if you can. And you say, okay, the cost of sales for these different divisions over the past 5 years have fluctuated between whatever, 80% and, well, let's say 70%, 80%, depending on which division it is. Okay, and then according to that, you're going to try and maybe get more of a normalized one, or maybe the future is going to be much more negative because there's a bread war and Pioneer built this thing that needs to be utilized. Then what you're going to do, you're going to obviously increase or decrease the gross profit margin. And how you do that is obviously through the increase or decrease of the cost of goods sold. Okay, so that's how you would look at that. Then on the selling and general and administration costs, that's obviously also a little bit of it's got a fixed and a variable component. But the main thing is that's a selling cost. You can't just you can't just fire your entire sales team. That's part of the thing, and it tends to be a percentage of sales usually. Okay, so and it's also highly correlated with the volume and the sales volume that you put through. So an example of that will be, maybe that's through the cycle, it'll be 10 or 15%, depending on how efficient you are. The important thing about that, these things will tend to vary depending on, if you look at food producers now, if you're a lip star that produces private label mostly, then you don't necessarily have a lot of like advertising costs, which goes into the SG&A. But if you're a Tiger Brands or a brand builder, you need to advertise your Koo tomato sauce or ketchup or whatever, then you're going to spend more money to build a brand all the time. So that's how those things will tend to differ between the models. Then financing costs, you can do it for two ways, either through I'm talking about if you're building a model forward. Either you can build it from how the thing changes, or you can have a fixed amount. You can either have a fixed percentage of your debt to equity, or alternatively what you can do, you can say, no, as the thing generates cash, it pays down debt, so I'm going to use that as an example, and then you use a spread according to cash that's in the either you say you're going to use that cash to pay down the debt, or alternatively what you can do, you're going to put that money into a call account, and the debt's going to be at a higher cost, and then obviously the spread, you're going to have a little bit more interest cost, but not as much as if you didn't generate the cash. So that's important with regard, and the financing cost is also important with regard to whether it's fixed or whether it's floating. If it's fixed, you know what it's going to be. So look at Anheuser-Busch, they fix their interest cost for I don't know how long, but 94% of their debt is fixed, versus if you are more floating, then obviously you're going to see, look at the FRA curves, which Mo would have taken you guys through, and you can see what you think is going to happen with the interest rate going forward. Okay. And the income tax expense, it's a few different stuff, but usually what tends to happen is you look at the history and you impute what the interest tax expense, income tax expense was. So in South Africa, there are certain companies that always has a slightly lower than 28% because of the way that they get deductions for their learnerships and all that type of things that they've got. And other guys are always slightly above, but usually 28% is a good place to go if they only got operations in South Africa. If it's a combination of the two, then obviously, well, it's a combination, I mean, like if they've got overseas operations and local, then obviously it's going to be a blend, and that will determine what income tax expense you have. Guys, this is the formulas. I don't think that's particularly difficult. The one thing I do want to say though, this and this is quite important. The effective tax rate is an income statement thing, or comprehensive income statement, whereas the cash tax is a cash flow divided by an income statement thing. That's important because the cash paid can vary quite a lot depending on what happened in the 1 year versus the other, and what was deducted. Okay, you've got deferred taxes and all that stuff. Okay. Any questions? Okay, still going strong. Retained earnings is what's on the balance sheet, what can be obtained from the income statement. Guys, I think that's very important. I speak to guys every now and again about this. Remember, accounting is a way of looking at things. Accounting is not necessarily correct. Okay. It's correct according to the accounting rules, but there's a lot of companies that's got negative book value. That doesn't mean the thing's bankrupt. Okay. So maybe they buy back a lot of shares and stuff. So retained earnings is obviously what's if there's a clean surplus approach, we're going to go through that in residual income. But what tends to happen is that the guys generate income and then they pay a dividend. So if you take your book value, your retained earnings beginning of the year, plus your net income minus your dividends, then you get your retained earnings at the end of the year. Now, because there's all these comprehensive income stuff like, so OCI items like there's a actuarial adjustment and there's this foreign currency translation reserves and all this stuff, completely throws these things off course when it comes to the clean surplus approach. And that's quite important because you can't always just use a price to book to determine something. Okay, that's one thing I want to convey to you. The residual income valuation methodology assumes that it follows the clean surplus approach, but there's a lot of companies you can't use it for. And we'll get to that when we get to the RI model. Okay, so inventory. If it's a company that has inventory and that's obviously selling inventory, then what's going to happen is as the company grows, and if your inventory days stay the same, then naturally the guys are going to have to increase the inventory holdings. And the way that you're going to see what the ratio is, so cost of goods sold divided by your inventory turnover ratio. You guys have gone through this, right? Because you should have gone through the financial reporting analysis. The important thing about this, if you are growing, okay, if the company is growing and the inventory days are staying the same year after year, then there's going to be a natural outflow of cash from a working capital perspective because you need to invest in more inventory. Okay, that's a hell of an important thing because that's going to determine when you work out the free cash flow to the firm of the company. And if you are let's say you're Motors, so Motors sells cars, okay, and your sales is growing, okay. As your sales grow and you're forecasting that it's going to grow, if your inventory turnover or your inventory days, whichever one you want to use, either you turn it over 12 times a year or your inventory days is 30 days. If it stays the same in your forecast period over the next 2-3 years, but your revenue is growing, okay, and you're saying the same margin now, obviously, then what's going to naturally happen, your gross profit margin is staying the same. Then what's going to happen is you're going to invest more in inventory because it keeps on. Your cost of goods sold is also growing with the sales. So does that make sense, guys? It's exactly the same when it comes to accounts receivable, because as your sales grow, if your accounts receivable day stays the same, obviously in an absolute value, your accounts receivable is also going to grow. And if you look at PP&E is going to be a function of if you need additional plant and also to produce more widgets or whatever you're going to do, you're going to have to invest because you can't just grow. Your capacity is X. Okay, if you need to grow more because you need more plant or something, then obviously you're going to have to put down that capex. Okay. And what's the important thing about that? Depreciation and capital expenditure. Capital expenditure, if you look at the cash flow statement, you have CFO, CFI, and CFF. So cash flow from operations, cash flow from investing activities, and cash flow from financing activities. The capex goes through the cash flow from investing activities, and the capex can be split into two. Either maintenance capex to keep the asset as in the same state, and the other one is expansion capex. So that's to increase the amount of stuff that you can do. Okay, so that's the capex side. What the guys tend to look at as well is they look at the PP&E as percentage of sales. That's one way to look at it. So it tends to be very similar. And obviously your PP&E is your PP&E minus your depreciation. Okay, so it's your net PP&E. And then what the guys tend to do is they say, you know what, I need to keep my PP&E at this percentage. I need to keep on spending money, and that's from a modeling perspective. Not necessarily it's going to happen, but that's from a modeling perspective. Otherwise, you use detailed company information. So you say, okay, the guy's going to have to buy so many cars, so many trucks, so many logistics, whatever. You can do it very detailed if you want to, but a quick and dirty way is to do it through percentage of sales. And what you also want to see is you want to see your depreciation compared to your capex. What tends to happen in a country like South Africa, interest rates in South Africa, inflation rates in South Africa is quite high compared to the US. So your depreciation tends to be much lower than your capex, And the reason for that is because of the inflationary aspect of it. So if you've capitalized, if you debited the PP&E at cost 10 years ago and you've got a 20-year life cycle, then obviously 10 years ago, 10 years on, you've got the natural inflation of that PP&E that you bought. Obviously now it's much more expensive, so depreciation will be low compared to what the new capex will be if you replace it. Does that make sense? Okay. Going a bit off track here, but percentage of sales. That's okay. Okay, then summary return. Inflation rate. Let me put it very easy for you guys. I need to have a property. I buy the property for 100,000 rands. 10 years on, that same property is now worth 200,000 rands. Okay. The depreciation on that property is straight line 10. Let's say straight line 10 years. Let's say 20 years. Let's say 20 years. Okay. So 100,000 divided by 20 gives me 5,000. So 5,000, 5,000, 5,000. If I have to replace that thing now, it's going to cost me 200,000. So then the depreciation would be 10,000. So what I'm saying is your capex to keep the thing at the same rate and to extend the life to that point will be. Does that make more sense? Okay. Maybe a bit too theoretical. I'll try and stick to examples. Okay, sorry for that. Okay, so return on invested capital is a metric that a lot of people use to see if the company is actually generating value for the shareholders. So you have two metrics that's important. You have return on invested capital and your return on capital employed. The difference between these two, ROIC and ROCE or ROCE, is that return on capital employed does not take into account tax, which is nice if you want to compare companies that's in various jurisdictions and you want to see if it, and obviously they've got different tax jurisdictions as well. So the one is a bit better comparison to ROIC. Okay, now ROIC, how do you calculate ROIC? ROIC is net operating profit or loss after tax. So you have to adjust it for after tax. It does not take into account interest. Important. And we're going to go to the denominator now, but the return on capital employed is just the net operating income. Okay. Then let me maybe just explain this. So ROIC is equal to net operating profits after tax divided by invested capital. So net operating profit after tax, another way to look at it, if the company just generates earnings from its operations, will be EBIT. EBIT after tax. One minus tax. That's one way to look at it. Okay, that's if they don't have any strange things that go through the income statement. Okay. Now, the invested capital is where everybody gets the stuff wrong. Okay. Invested capital, think about it. How much money did you invest to generate that thing? Now, remember your EBIT is generated from all the sources of finance. Okay. Now, the invested capital is PP&E. Usually you do it for intangibles as well. So PP&E, sometimes the guys include or exclude goodwill, depending on. Intangibles, if you have patents, you definitely include it. Your debtors, you will definitely include. Sometimes the guys include cash or not. But what the guys will say is, from the invested capital, operating assets less the liabilities. And the liabilities in this case, most of the time, is going to be your accounts payable. Okay. The rest of the stuff is your accounts receivable, your inventory, your patents, your PP&E, all the stuff that you needed to operate. An example of what is not an operating asset will be the holiday home that the guy has at the beach that's on the balance sheet. That tends to be non-operating. Yeah, the guys tend to exclude that as well. Sometimes what the guys do is, depending if it's a deferred asset or liability, if it's a liability and it's going to be there very long, they just put it into equity. I'm talking more of a ratio analysis, but that's going a bit. No, long-term debt is not included in this. Okay, yeah, guys, this is important. So if you think what this thing is saying, it's saying how much are you generating from your operations? Okay, so if you've got, so just think about it from once again, who's funding your company? Okay, if you've got, let's say you've got 0 PP&E, you've got 100 rand debtors, 100 rand inventory, you've got 500 rand. It's actually a bad example. Let's say you've got 100 rand debtors, 100 rand inventory, and you've got 180 accounts payable. Okay, so then it's 20, just on a very basic perspective. And your net operating profit is, let's say, also 20. That's 100% that you return on those operate. That's exceptionally good. What this thing is calculating is how efficient you are using your operating assets. And in this case, obviously, if you're using accounts payable, that guy's funding your balance sheet. I'm not funding it, he's funding it. And that's what happens, that's what tends to happen with ShopRite and with these guys, because the guys pay them immediately in cash at the till. Obviously the stuff is on the shelves for a certain amount of time, but the nice thing is Tiger Brands gives them 90 days or whatever. And that's why, even though those guys have got razor thin margins like 3-4%, when it comes to net profit, they've got very, very thin margins. The fact that they get the suppliers to fund them, firstly, and secondly, the fact that they've got such huge inventory turnover, that causes the ROE to go up to like 20-30%. Okay. No, but remember, the debt is also generating the operating profit. So it's both sides, but it cancels out. So the debt. So let me just put it this way: this is not. I'm saying that the guys are funding you, but it's operational funding. It's not a long-term funding, so it's not considered funding. Accounts payable is not considered funding, guys. It's not. It's like it's part of the operations that you go through. I might have. Don't want to confuse you from that perspective. That's why you don't include equity or long-term debt in this calculation. And also remember, the guys that are long-term funders, your equity, preference shares, and your debt guys, those guys funded you, and that's why you're generating this no plat. It's like, but they shouldn't. What operating? They're talking about PP&E. Yeah, but it's a confusing concept here now. So the thing is, what you're doing, let's say there's no accounts payable. Okay, so that's the funding side, that's the asset side. Let's say all of this stuff is operating assets. Okay, because this is equal to that. We've got that. Assets equal to liabilities plus equity. We've got that equation. Okay. This thing is operating, and it gives you at the end the no plat. Net operating profit or loss after tax, or the no plat. Okay. So that's why you shouldn't be confusing the two, because then you're double counting. If you're using the debt and the equity and stuff. Because you've used this funding to purchase maybe but you're not necessarily always going to use it to purchase inventory, but you're using that to fund the operations of the company, whether it be PP&E or patents or whatever. It would also be inventory, because obviously more the equity guys and so on will probably be the guy. But anyway, where it goes, cash is fungible. It doesn't matter who funds what. The point is, the funding side funded the operations of the company, which is the asset side, and the asset generated the operating profit, which is here, and that's why we've got this calculation. Okay, and once again, the operating liabilities is part of the operations. The guys, for you to do business, that's part of it. Okay, because the guys are giving you, it just decreases your cash cycle. Okay, are we confusing? Or is it getting confusing, or does everybody get that? Well, all the funders, not the no. Guys, just important. If the profit doesn't belong to the accounts payable, doesn't belong to them. It's generated by using both funding, and then you give the debt their required share, and then the rest is for the equity guys. Guys, when I say it's, remember the debt guys have got their interest in their principal. The equity guys is the one that's a volatile one. What's left over after you've paid the debt, interest and stuff is going to the equity guys, whether it's more or less. Okay, that's why it's more risky. Definitely not. No, assets are the operations of the company. Guys, what is if you're a property company, and this is you don't use this in property anyway, you use a different metric. But if you're going to use a property thing, the assets that you have, don't think of operating assets as like current and non-current assets in the balance sheet. That's where you're getting confused, and that's an accounting thing again. Who cares about accounting here? It's got to do with the fundamentals of the company. The fact that we're operating in this office. We're operating in this. I mean, obviously, I'm not going to go into the lease standard now. That's a very different thing. If you buy a property, that's part of your operations because you need the property to do the operations of the company, the day-to-day stuff. Not that it's a long-term assets, I agree, but don't think about non-current and current assets when you think about operating assets. Operating assets means it's part of the operations of the company, whether it's got a 5-year life or 20-year life or 2-year life. Okay, does that make more sense? That's where the confusion sets in. Source of capital is relevant except if it's an accounts payable. Except if it's accounts payable. Say again? Would I include? Yeah, overdraft will be part of that. Yes, definitely. Well, overdraft is cash, so it's a very short term. Yeah, if you exclude long-term debt or equity, it doesn't matter what they fund. Okay, guys, we spent way too much time on this. Yeah. So is that for invested capital? So that will be like an enterprise value thing. So it depends if it's excess cash or not. Okay, well, this is also very theoretical. So if say again? Yeah, guys, let's park this for now. We'll get to that later because we're going around in circles. Okay. ROIC, ROCE, you don't take off the tax with operating assets. With ROIC, you take off the tax. Okay, done. Remember that question when you get to the private equity example. Okay, we can go to that. 5 forces we kind of already gone through. What's inherently good, what's inherently bad. I'm not going to go through that again. You guys know what it is. Judge the competitiveness of it. So in the exam, they might give you a thing where there's lots of suppliers, there's very few buyers of the product, whatever. Then you just have to say whether it's a strong force or not. Okay. So what? Okay, no, that's easy enough. And then what affects it? Geographical location, taxes, government regulation. Guys, just think about, like, if you think about gambling. Gambling has got certain licenses. There's a government regulation attached to that. If you think about weather, that's going to be the agricultural stuff. You think about fertilizers demand's going to be dependent on whether there's a drought or not. I mean, this is just basic stuff when it comes to analyzing a company. Like, what would you think about? If you think about Vodacom, it's got all these issues with spectrum and the government. You guys get the point. Okay. And then obviously whether they can put this stuff through or not. And then technology has obviously got several advantages. So you can either make the cost of something much lower, or it can just give you a substitute product. Okay. There are many different examples of that. The one I always like to use, think about Videotown and think about Netflix. I mean, there's not a Videotown anymore, so that's extremely, well, there is one, but I'm sure that's not for rental purposes. Yeah. I'm not going to record. I don't need to pause this. Okay. Blah, blah, blah. You guys know what that is. Okay, then forecast horizon should coincide with the investment horizon. So if you're going to invest for the next 5 years or 20 years or 2 years, so project finance, for example, in a bank, will build a proper long-term 20-year model or stress test, all the stuff and so on. If you're only going to hold the equity for the next 3 years, I mean, obviously you're only going to build a 3, maybe 5-year model and then just exit exit, work out a terminal value at the end of the time. Okay, so that's where the terminal value calculation will come through. Okay. Important thing about, so this is where they talk about the cyclical company. So if you think about a cyclical company, it's a company that's go through cycles. Okay, so what you're trying to do, so let's say that's the earnings. Let's say this is an agricultural company, or it's maybe a company that's like a discretionary income, so it will go through the business cycle. Okay, what will happen is if you estimate the company's EPS and everything, and you work out the things there, like there, and there. Let's say this is T0, that's T1, that's T2, and you exit it on year 2. Then your value is going to end there. Okay, I'm just as a rough estimate. So it's way out of cycle. If you exit it here, it's too low. You guys understand what I mean? The stuff goes through cycles, EPS goes up and down the whole time. So you need to have a normalized number to exit it. And once you've worked out the normalized number, then what you can do is you can work out whether this thing is a good buy or like a buy or sell. So if you think about the commodity companies now, all the mines. The mines look super cheap on EV to EBITDA and all this stuff, and they probably have a little bit to go, I don't know. But the point is, peak margins for these guys. I mean, it's insane how much these guys have made over the past few years, and that's because there was a super cycle in commodities. Okay, now if you start to work it out and you exit the thing at if you don't work out a normalized number, you're going to say that everything's a buy. Okay, if you normalize it, then you're going to say, oh, okay, now this one's a buy, this one is not a buy, this is the stuff. So that's why you need to work it out from a cycle perspective, because otherwise you're going to buy at the wrong time. That's basically what it means. Okay, then summary. When developing projects beyond the short term, one method is for the analyst to assume that the growth rate from previous periods will continue. You can then forecast longer periods based on this growth. Guys, this is just basic stuff. The main thing is that you need to normalize the stuff, take out the cyclicality that you can exit or determine a terminal value based on a normalized number. Okay. No, you look at the past and you determine where you are in the cycle. I mean, let me ask you guys this: do you guys think that looking at what happened in 2001 in the States with all the technology stuff and all the thing that crashed, and looking at the IPOs that's coming to market that's not generating profits, do you guys think I framed this question as well? So. Do you guys think we're on the top of the cycle or at the bottom of the cycle? Okay, so you're gonna, that's it. So you need to normalize down for that. That's an example of that. Okay, work out all the stuff, balance sheet, cash flow statements, and then according to that, then you're going to do the valuation, which we're going to go through now, which is going to be the free cash flow to the firm and free cash flow to equity. Okay, which of the following parts is least likely part of organic growth? Guys, when you work out the top line of a company, especially when it comes to maybe a cement company or a bread or a cigarette or whatever, you're going to work out the volume growth and you're going to work out the price growth. M&A is not part of the organic growth for the company. M&A is the exact example of inorganic growth. Okay. Moving on swiftly. Okay, I just want to finish this one and then we'll take a break. Okay. Are you guys happy, or do you guys just want to keep on going? Let's finish this one, we'll take a break, and then because then I can answer the questions offline. Okay. So now we're going to go into DCFs. So what is a DCF? DCF is you just take a cash flow in the future and you discount it back by the appropriate discount rate. That's the formula. As easy as that. Cash flow divided by 1 plus R. R is your required rate of return and to the power of whatever. So if you look at the timelines, all that you're doing, you've got cash flow 1, cash flow 2, cash flow 3, cash flow 4, and you're going on into perpetuity. Okay. That's what you're doing when you're doing this kind of cash flow. You're taking this cash flow and you're discounting back. Same with that, going on and on. Okay. To make things simplified, what you're doing is you're working out a terminal value at a certain point. So you maybe use this as your cash flow to calculate the terminal value. And once you've worked out the terminal value, and this is where everybody gets caught up, if this is cash flow 4 that you're using for your terminal value, then you're working out the terminal value in year 3. Okay, so you're using that cash flow, and you're working out the terminal value in year 3. Once you've worked that out, you still need to discount that thing back by 3 years. We're going to go through an example. I just wanted to highlight this now because that's where every single person I speak to get the thing wrong. Yeah, and I'm sure none of you guys are going to get this wrong because we're talking about it now. Okay, so that's the cash flows. So which streams can you get? You can get dividends. Dividends are nice because you discount that back to the cost of equity. Very important, cost of equity. That's obviously only if the company is actually paying dividends. Okay, so if they're paying dividends, it's got a nice dividend policy, and you have a minority stake. Why is that important? Because you cannot determine the cash flow, the operating, investing, and financing cash flows of the company. So you don't have control. You just have to sit there and wait for your juicy dividend to come later. Then free cash flow. Free cash flow gets split into 2. You get free cash flow to the firm, and you get free cash flow to equity. What's the difference? The difference is free cash flow to the firm is for all the providers of funding, not the operating guys, just the debt and the preference shares and the equity guys. And your free cash flow to equity is only to your equity guys. So that's after you've paid the other guys, after you've paid the debt and the preference share people. Okay. So another way to look at it is it's a cash flow that's left after you have spent the relevant stuff to keep the company in the way that it should be. Whether you're also expanding it or not depends on the capital expenditure. Okay, that's important because it's not the same as net income. Okay, and it's not the same as cash flow from operations either, because it's cash flow from operations, and you're taking off the fixed investment as well. And then the last one, and this you will do it if you've got a controlling stake. Controlling stakes means that you can determine the cash flow. So you can determine how much free cash flow you want to get because you can determine how much capex you want to spend. Okay. And it's also very good if the company's not paying dividends. And then the last one here is the residual income method. The residual income method is probably going to be the most difficult thing we're going to do today. It is not particularly tricky if you understand how the mechanics work from a book value perspective and the stuff that generates above the cost charge that you're putting through. Important thing about the residual income value or income method versus the free cash flow or the dividend, the discount cash flow method, is that the majority of your value doesn't sit in your terminal value. It sits at the beginning book value of your model. With that said, you can only use it if the clean surplus approach is valid or exists. And what does that mean? It means that the accounting, you don't have all these funny things going through other comprehensive income, which is hell of important, because if you've got all this thing coming through, then your equity value is going to go haywire. Then you can't use this thing. Then you go back to either free cash of the firm or dividend discount model, maybe even a multiple if you want to. Okay. Wait, say again. You mean like no, free cash to the firm? Yeah, to the firm. No, to the firm. Because you as a bank can force the guy to pay. Well, depending on your covenants and stuff, it'll be. So, did you guys hear the question? It's actually a very good question. So the question is, which one of the 3 methodologies with the bank? So obviously the credit department. Which one of those 3 valuation methodologies would be more appropriate for a bank to determine if the corporate person can pay them back? And it'll be free cash flow, because that's what the company is generating. So you want to make sure there's a nice fat margin for them to. I mean, you don't care if the equity guys are making money, because then you're also making money as a bank. But you want to make sure that there's a cushion in there, that there's a buffer. Okay, whereas the residual income is like a very theoretical thing. And the dividend is, you're not getting a dividend as a bank, you're getting a debt repayment. Does that make sense? You're going to use, but the point is, a bank doesn't care about the dividend policy of a company. They care how much cash flow it's generating, because they want to make sure that they're going to get their money back. So it'll always be free cash to the firm. Okay, not free cash to the equity either, it's free cash to the firm. Okay, I think that was a good question. Okay, let's continue. Okay, so DDM, Single stage, multiple stage, whatever, it doesn't matter. Let's go through the example. Entity XYZ is expected to pay a dividend of 90 cents next year. The next year is important, guys, because 1 year out dividend. And the price is expected to be $30 in year 1. So they actually give that to you. That's super easy. With the value of XYZ stock, if the required rate of return is 10% and the risk-free rate is 5%, what do you need? Guys, we do not need the risk-free rate because we've already got the required rate of return. What do we know? We know it's 30. We're going to start it for 30, so that's actually your terminal value, to be honest, plus your 90 cents. And because it's the same time period, divided by 1.1 to the power of 1. And you get this thing right here. Okay, how did you calculate that? Cash flow 1 divided by 1 plus r to the power of n. Okay, that was the first thing we did in the... This is the easiest one that you could potentially get. Okay. Then on multi-stage models, obviously there's going to be a price that you set it at, and there's different dividends that you're going to get. So that's D1, D2, D3, D4, and maybe the price that you're going to get them back in year 4 as well. You're going to add those two together. You're going to discount it back by 4 years, 3 years, 2 years, 1 year, done. How does it work when you discount something back by 4 years? 1.1 to the power of 4 in the denominator. That's all it means. Or 1 plus r to the power of whatever time period it is. Okay, everyone got that? Okay. So the Gordon growth model, what the Gordon growth model assumes, and you guys have gone through this already. If you can remember where that whole thing about you go through the embryotic phase, the growth phase, the shakeout phase, mature phase, and decline phase. Can you guys remember that? Okay. What it means is that you're basically somewhere there, the Gordon growth model. Might even mean you're in the decline phase, but the point being is that you are very stable, you're not growing massively anymore, it's very predictable, and that's why the guys use the Gordon growth model. And the tendency is that your Gordon growth model's growth will not be more than the GDP of the country. Okay, that is the thing about the Gordon growth. Okay, wait. Over the long term, guys, because remember the Gordon growth model assumes that it grows that much into infinity and beyond. Okay. Okay, we've gone through the Gordon growth. Then assume that we have the following: price of the stock, expected dividend next year, estimated required rate of return. We can infer the growth from that. Why? Because we know D1 divided by R minus G is equal to the value of the thing. If we know what the price is in the market, then automatically what we can do, we can calculate the G because we just replace the value with the price today. And that'll give you a very good idea of what the expectation in the market is for growth. And a lot of people impute that, especially when you start to go into derivatives and stuff. A lot of people use this for sentiment in the market. Okay, very easy. I don't think I need to go through that example. Okay, so now we're going to get to the present value of growth opportunities. And this is a little bit more tricky because what we're going to do is we're basically working out what we're paying for growth in the company. Okay, so first of all, this model assumes that the company is split into two. It's split into a value for a no-growth firm. In other words, it's not going to grow its earnings, it's not going to reinvest anything, it's just going to stable. It's like a bond or a perpetual bond that's going to pay you the same coupon every single year. And then you've got the growth option as well, and that's what you're paying whatever for. Okay. So now what's going to happen is going to say you're going to work out the value of the no-growth firm, and then you're going to add the portion that's whatever, the opportunity for the future growth. So let me give it to you in a very basic way. If you look at a company that's generating 10 Rand of earnings per annum, okay, 10 Rand. Let's do 10. Your required rate of return, let's just make this thing super easy, is 10%. Okay. Equity. It's working out the equity here. We're working out the value of the company. It's a PE. It works on a PE thing as well. So then we know this thing's going to generate 100 or 10 Rand every single year. So for a no-growth firm, we are going to pay 100 Rands. Okay. If this company is trading at 300 Rands, okay, so it's trading at 300. We know that 100 divided by 300 is a third. So a third of this thing's price is for no growth. 2/3 of this thing is for the growth it's going to give you in the future. Another way that you can look at it from that perspective is that this company's got a 30 PE, historic now, and the 30 PE, 10 turns of the PE is for no growth, and 20 turns of the PE is for the growth. Guys, does this make sense? Okay, don't need to bog down on this. Yes. Current earnings. Yeah, you can use both, but it's usually current earnings because there's no growth. There's no growth in the future. So, okay. There's the thing. Present value of growth opportunity. Guys, the main thing is that if you think about South Africa, it's got a certain cost of equity anyway. If it's 15%, the thing's generating. I mean, it's the same thing over and over. Earnings divided by required rate of return, which is a no-growth earnings. So it's like a perpetual preference share almost, like the same valuation methodology. And then the additional stuff you pay above that is for the growth. Okay. If you do this for a company like Amazon and those things, you'll find out that the value that you're paying for growth is way in excess of 80%. Way in excess. Okay, so for the current operation, you're paying way, like you're not paying a lot for the, well, the value of the stock in the market, the current operations is a very small portion of that price in total. Okay, and it's quite a nice thing to do, because once you start to do this, you start to realize there's a lot of companies out there that people are actually giving a negative value for the growth of the future. Okay, and the example of that will be BTI. Okay, guys can go through an example. Then when it comes to the justified PE ratios, and this is where people get a little bit stuck as well, because it is a little bit complicated. Okay, now when you think about justified PE ratios, you can either have a leading or a trailing PE ratio. What's the difference? A leading PE ratio is next year, trailing is last, or the period that just passed. Guys, the important thing about this, okay, so everyone understands a PE ratio is the price divided by earnings. Okay, that's a market PE. The justified PE, what it does, it takes the Gordon growth model and it uses that model to basically, and it reworks a little bit to get to the justified PE ratio. So let me do that quickly. Your Gordon growth model. Okay, we're going to substitute value for P now. Okay, so price is equal to next year's dividend divided by R minus G. Okay, that's a Gordon growth model. Everybody understands that. Everybody's happy with that, right? If we divide this thing by next year's earnings, what we get is we get the payout ratio. Does everybody get that? Because your dividend next year divided by your earnings next year is your payout ratio. Because everybody got, and payout ratio is the same as 1 minus your retention ratio. I don't know why they do that in the, makes it a little bit more complicated, but anyway, okay. So what this means, it means the payout ratio divided by your required rate of return minus your growth. Okay, does everybody get that? That is your forward justified PE ratio derived from the Gordon growth model. So that's bad boy over here. So that 1 minus B, that is the same as your payout ratio. 1 minus B is 1 minus retention ratio, payout ratio, divided by R minus G. That is your forward justified PE ratio. Okay. Now, D0 is your dividend that was just paid. We are growing it 1 year. Okay? What does that mean? Means D1. Everybody have that? Okay. Minus divided by R minus G. Now instead of dividing by E0, or sorry, E1, we divide by E0. This entire thing divided by E0. And what do we get? We get the payout ratio times 1 plus G divided by R minus G. So, it's equal to payout times 1 plus G divided by R minus G. Guys, remember payout is a percentage. How much you pay out of your earnings. So it's 40. If you earned 40 Rand and you're paying out 10 Rand per share, then it's a 25 payout ratio. I mean, it's 10 divided by 40, so it's quite easy. Okay. Payout ratio as a percentage, or 1 minus retention ratio, whatever you want to do, it's the same thing, times 1 plus G divided by R minus G. Okay. That is your trailing P ratio. Okay. Now, the more important thing, once you understand this, and once again, you can derive this by yourself in the exam. If you remember the Gordon growth model, you just divide either by E0 or E1, depends on what you want to do. Okay. If you forget which one you need to, which one's got the 1 plus G in the numerator, the leading on the trailing thing, remember this. When you work out, I don't know if I'm going to confuse you guys more or not, I hope not. If the market price of a share is 100 rands, okay, and the earnings that was just reported was 10 rands, then the trading PE was 10, or is 10. Okay. If the company grows and your forward earnings 1 year out, so your forward market PE, the earnings is estimated to be 20 rands, then your forward PE is going to be 5. So in a market where the thing is growing, where your earnings is growing, because remember your P stays the same, you always use today's P. You use earnings either that was just reported or forward earnings. Then historic is 10, forward is 5. So everybody with me on this thing, so okay. Then the way that to remember this is the higher PE ratio between the one that's going to be higher between a trailing and a leading PE ratio is going to be the trailing in a market where the company is growing. Okay, did that make sense? Okay, I see some confused faces and some. Okay, easy way just to derive this is the E1 or E0. Once you've worked it out, it's fine. Don't confuse the subscript though. Okay, and that gives you this essentially. Okay, do you guys want to go through an example? Let's go through an example, huh? B is retention ratio. 1 minus B, yeah. Okay. Let's go through a quick example, guys. Current stock price, 25 euros. Trailing annual earnings per share, $2. Current level of annual dividends, 50 cents. Why is that important? Because we can work out the payout ratio. 50 cents divided by 2 is equal to, so the payout, 25%. That's very important. Dividend growth rate, 1.5%. Risk-free rate, 2%. Equity risk-free, 4. Beta. Alright, okay, so now they gave you all this crap because you need to work out the capital asset pricing or the cost of equity. Okay, once you work out the cost of, I'm not going to do it now, that's the thing, 5.2%. You know what the growth is? The growth is 1.5% because they gave it to you, and we worked out the payout ratio as well, which was 25%. And once you've worked that out, done. It gave you all the answers. The growth rate, the G, the R you had to calculate, that was a little bit of a tricky thing. And then obviously you've got the payout ratio because it's 0.5 divided by the 2, which gives you the 25%. Everybody get that? Okay. Okay, I spend a bit more time than normal on this because I know I'd rather spend more time on this that you guys get it now than just skip it over because this is quite important. Okay. Okay, then the fixed rate perpetual stock, the same as what you're going to need to do with the no-growth firm. So you're going to have your coupon or your whatever, the thing that's paid, your dividend, divided by R, which is your required rate of return. Because it's perpetual, there's no growth, it's just that, your dividend divided by R. Okay, it's exactly the same that you do your present value of growth opportunities. You work out the value of a no-growth firm. You take the value currently minus that, and you can work out what you're paying for the growth in it. Okay. Here's an example of that, guys. I think this is. So anyone want to go through this? It's like it's literally just you work out the coupon, par value times the spend percentage that's paid out divided by the required return. If you guys have got that. Well, you're never going to compare historic with future P's. They'll never give you a historic P of one company and a forward P of another company. They'll give you what they might ask you in the exam, guys. This is actually quite a little bit reworked. But if they ask you an exam, the trailing P's of both companies 15 and the forward P of one company is 12 and the other one is 10, then you automatically know the one that's got a forward P of 10 has got more growth. So that's the way that they might ask you. But they won't ask you to say the historic P of this company is 5 or let's say the story company of company A is 10, and the forward P of a company B is 12. They won't. It's you can't. It's not an apples to apples comparison. So they have to give you both to give an idea. But if they give you both, and the P's of the one trailing are the same, and then the forward is different, then the one with the lower forward P is the one that's got more growth. Okay. In characteristics, guys, you can go through this. You can't use a Gordon growth if the growth is more than a required rate of return. It doesn't work like that. You can't use the Gordon growth if the company doesn't pay a dividend. I mean, you literally can just go through this. This is very, very basic. And remember, the big thing about that, big negative about the Gordon growth model, it's extremely sensitive to R and G. If you change that by 1%, one way or the other, it can make a big impact. If your R goes up, how much required rate of return goes up, the value of the company goes down. If your growth goes up, the value of the company goes up. If your payout ratio, this is now more for justified, if your payout ratio goes up, the value of the company goes up. Okay, that's how this thing works. Okay. And they use the Gordon growth model to exit the thing. So that's how people used to determine the terminal value of the company. Okay, which of the following, blah, 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 you can use that. Now with regards to the other models that the guys use. Okay, we know what the two-stage model is. The two-stage model is you've got one thing that's got high growth and then it exits it out. Okay, how does that work? You just literally discounting back dividend 1, 2, and 3 or whatever for the high growth phase, and then the normal phase you're going to use the Gordon growth model to exit it at that point. The H model, what it assumes is that there's going to be very high growth that's going to go down. It's going to like go down naturally. Okay, and that's a different way of looking at it. Like it's going to be this supernormal growth phase, and then it's going to be a phase where it's in transition essentially. That's the H model. Guys, nobody uses the H model. You just use a spreadsheet. But the H model is just the easy way of looking at it. And then the three-stage model, same thing. You have very fast growth the first phase, still fast growth, but less fast in the second phase, and in the last phase, it's stable, and that's where you're going to use the Gordon growth model. And now I want to go through an example because the stuff can get tricky. Okay, and then spreadsheet modeling, that's what everyone uses. Okay, which of the following is correct assumption for a multi-stage model? Oh, guys, that's not it. Let's go through the thing here. This two-stage thing looks very, very complicated, but it is actually, once I explain it, it should be quite easy. Okay, now let me enjoy this. Okay, so you've got a normal thing about your dividends. So you've got dividend 1, dividend 2, dividend 3 up until T, okay? That you're going to discount back in the variety of stuff. So we've done that before. Dividend 1, you discount 1 year. Dividend 2, you discount for 2 years, etc., etc. Okay. Now this term is the one that everyone gets a little bit confused about. Now, the thing that's important about this is that, excuse me, if you look at this formula, it just looks long, and it looks a little bit complicated. But if you look at, I hope this thing doesn't go to black. If you look at this, if you look at this, and you replace that term with D0, right? You've basically got the Gordon growth model. You guys get that? Okay. So instead of thinking about this thing as D0 times 1 plus G subscript S, so the super growth phase, to the power of whatever, to the power of N, think about that as the same as D0. Because what you're working out the dividend at the point that it's going to transition into a normal mature phase. You're growing it 1 year, and you're working out the terminal value by R minus G. That's why the G's got the subscript L, because that's a low growth. Okay, let me give you a timeline. Okay, 1, 2, 3. Okay, first 3 years dividends are growing by 20%, super high. Okay, our required rate of return is 10%. Okay, so 20%, 20%, 20% every single year. And this is D0. Okay, I'm not going to fill it in with numbers. You guys can paint with numbers. Okay, once you've determined this, you're going to discount back D1 divided by 1 plus R to the power of 1. which is 1.1. Okay, so your denominator is 1.1. And this one, you're going to divide it by 1.1 to the power of 2. And this one, V3, you're going to work out, you're going to discount that back by 1.1 to the power of 3. Okay. And you've worked out the various dividends because you've grown, it's path dependent. You've grew it by 20%, then 20%, and then another 3%. Okay, so 1 year, 2 year discounted back, 3 years discounted. Now, because we've done this, we've worked out D3. Okay. D3 needs to, now this growth going there is going to 5%. So it's a lower growth phase. Because of that, you're going to take D3, 1 plus 5%, divided by 10% minus 5%. Have we seen this before? That's a Gordon growth model. The only thing that's different here, it's not D0 anymore. Now it's D3. Okay. The reason why is because the mature phase kicks into play here. Okay, now the fact that we've done this, we've worked out a terminal value. We worked out D4 by doing this, and this kind of, and basically to work out terminal value. Now the important thing is terminal value in year 3, not in year 4, it's in year 3. Because remember that the Gordon growth model is D1 divided by R minus G, and that gives us the value in the year 0, which is today. Okay. We work out D4 divided by R minus G, we get the terminal value in year 3. Now that we've done that, we need to discount back the terminal value, and that is where they always catch you because people forget to do this. You divide that terminal value by 1, 1,1 to the power of 3, done. You add those together, you have that two-stage model. Okay, does everybody get that? Okay. People get this thing wrong so often because they get confused. Now the H model is not particularly complicated. The only difference here is that, so you've seen this, G0 times 1 plus G, the lower growth, divided by R minus G. That is essentially you're exiting the value today in the low growth. What you're doing here is that you're working out the incremental value of that super growth phase at the first point. So you take half of the high growth phase, that's the H value. So VH, so H is the half-life of the high growth phase, times the dividend, well, D0. And then you take the high growth minus the low growth. So you take the incremental growth, okay? And you divide that by R minus G. And you always lose the denominator is always the low growth G. So it's literally what you're doing. Literally what you're doing. You're working out. I'm going to use area now, so I don't confuse you guys. Okay. What you are doing with this thing, you are working out. Basically, this is the high growth phase, and this is the low growth. Well, let's make it like this. That's the low growth phase. Okay. What you are doing, if you exited it here, if you exited normally, you would have done this. We've worked out that on your terminal value from year 1, and what you're working out with the H model, you're working out this. So you're adding that. Okay, so I don't want to confuse you guys too much on this stuff, but that is essentially what you do. So the main thing here is that it's the incremental growth divided by R minus G into 50. Okay. Let's go. Okay, that's just a summary of the stuff. We're going to use various stuff for the thing. So if it's a high growth phase, you might use a three-stage model because you might have very high growth in dividends. Then it like the growth itself and the absolute dividend is very high, and then it goes a bit slower, and then it matures. Okay, so that's the 3-growth phase. Why would you do something like, or why would it grow something like that? Due to the fact that your ROE is extremely high compared to your requirement. In the mature phase, which you're going to use the Gordon growth model, your R basically is equal to your required rate of return. So it's very, very low. The growth is not going to be super high, it's going to be basic. And then the transition phase is basically the H model. Okay. Describe terminal values, explain alternative approaches to determining terminal value. So we've done, let's just go through the example. Zach has recently paid, that's D0, $1 dividend, 1.1 dividend, and it's expected to grow 5% for the next 4 years. At the end of year 4, the dividend payout is expected to be 40%, and the trading fee is expected to be 15. If the required return of ZAC is 10%, and what is the VF? What a lovely example. Okay, now trading P 15. We know from the the justified P ratio how to work this thing out, because we have R, we have G, and they give us the payout ratio. That's like easier than what possibly could get. Okay, so payout ratio is going to be 40%. Okay, required return is 10% and expected to grow 4% for next at the end. Dividend payout. Okay, so it's going to keep on growing. Well, you don't need to R minus G, so you're still going to expect the growth to be 5 in your multiple. Okay, so let's okay, so temp R is equal to 10%. Payout is equal to 40%. Okay, and your P ratio is 15. Okay, so you can actually work that out and work out what the thing is, because you're going to flip it around. Okay, so EPS, okay, D4, let's just work out D4 quickly. 1.1 times 1.05 to the power of 4. The reason why is because 5% growth every single year. So 1, 2, 3, 4. So we're growing that every single year by 5%, and we get to this value. Okay, then the payout ratio is 40%. So from that you can impute what the earnings is going to be. So D4, we know that because we worked it out, divided by 0.4 gives you the earnings, gives you the EPS actually. And the reason why, because obviously, I mean, payout ratio is the dividend divided by earnings. So obviously if you've got two of the three variables, you can work it out. So EPS in that year is going to be 3.34. Okay, now you're going to multiply that by 15, and the reason why you're going to multiply that by 15 is they gave you what the expected trading fee is going to be, is 15 times, and that'll give you the exit. Okay. So a lot of times what the guys do is they either work out a justified fee at the exit, or they use a market multiple or whatever they expect it's going to be. And because you've worked out the exit, remember the exit is now here. You've worked it out. But very big difference from the normal terminal values. You have worked out the terminal value here, not taking it back 1 year, because you expect it at that point to be trading at 15 times trading fee ratio. That's the very big difference between this and the Gordon growth. So you need to take that back 4 years, and the same with dividend 1, 2, 3, and 4. You need to discount that back, and then what are you going to get this? Actually, that's just this. We do the dividends. What did they ask? Oh, they just asked the terminal value of today. Okay, so they didn't ask the total value of the sheet. The big difference between this and the Gordon growth model is you don't take it back 1. The reason why, you've worked out the EPS in year 4, and they gave you the multiple in year 4 has to be 15. So you just take the earnings, multiply it by the P ratio, they'll give you the value, and then you discount that back. So it's at year 4. That is 2 different ways, huh? Okay. Yeah. You have to, guys, the big thing is, remember, it once again, it's path dependent. So path dependent, you have to grow the dividends to get to D4. And at that point, obviously, because they gave you the payout ratio, you can work out the earnings at that time, and they gave you the multiple. But they actually didn't have to give you the multiple. If they gave us the growth afterwards, they actually didn't give it to us. They only gave it us for 4 years. But if they gave us the growth afterwards in year 4, you probably could have worked out what the justified fee should have been if the question asked that, and then you could have used that to work out your exit at that point. If it don't give you the other stuff. Okay. Okay, company has recently paid a dividend, expected to grow at 15% next 2 years until growth roughly decreases to the long-term growth of 5%. If the required return on aid is 10%, the value of aid is. Okay, guys, it's just a 2-stage model. We've gone through this already. And don't get too bogged down on the sigmas. Okay. Okay, this is the H model, so I want to go through it. Company XAV recently paid a dividend of 3, so D0 equal to 3. The required rate of return on equity is 8, so R is equal to 8. Dividends are expected to grow, so G short term is equal to 17. H is equal to half of 5, and 11% for the next 10 years, and decline, okay, no, that's half of 10. The decline linearly because this thing didn't decline. 5 to 5%, and the estimated value of VS, the second and third stage, is closest to. Okay, now the thing here is that obviously what you're going to do, you're going to have to work out what the dividend is at the time it enters the H model. Okay. So that's 4. So first of all, D0 is equal to 3, so that phase is 5 years. Okay, so super high growth for 5 years. So D0, which is 3 times 1 plus GS. GS is 17%, as you can see here, to the power of 5, because it's 5 years. So what's going to happen? This is 5 years, 17% growth. This is 10 years, and it goes down from, what's it from? From 10 to 5%, and then thereafter it's going to go by 5%. Okay, so it's worked out this. This phase here is going to be 10 years, so H is equal to the time period divided by 2. That's how you get this 5. So you get this 5. So you're going to use this DS, so that's basically D1. You're going to say, you're going to grow it on the slow growth, because now you're working out the normal Gordon growth at the first term, and the second term you're going to do the incremental one. So this is D5, yeah. This is D5 plus 1 plus 5% divided by R minus G, which is the 10% minus 5. So this is the same as the Gordon growth model would do. Okay, in year 5. Then you add to that the incremental thing around that. So that's going to be the D0 times 1 divided by, 10 divided by 2, which is the 5, times the difference in the high growth and the low growth. Is it 11? I thought it was 10%. Oh no, it's 11%. 11%. Minus 5 divided by R minus G. And then you get the value for those two. Okay. I didn't ask the present value of it, I asked the value at that point. Yes. There's 2 high growth periods here. There's a super high growth at term 1. So this is the very, very high growth period. This is the transition period. And this is the mature period. They told you to choose the second one. So what you're doing here, remember all that you're doing, you're just growing the dividend. So you know what the dividend is. Like 1, 2, 3, like you can just discount those dividends back. You don't need to transition it. I gave you this. Second and third stage. They told you to choose the second. Okay. Great. Yeah. Guys, if they chose you to, if they asked you to get the value of the company, then what you would have done, you would have worked out you could have worked the H model here, which will give you these two, and you would have discounted back 5 years. So this thing you would have discounted back 5 years, and you would have worked out every single dividend here, and discount each one of them back, and then added this stuff together. If they ask you the value today. So just check in the exam what they ask with regards to where in the time period you need to go. Okay, everybody with me? Okay, this is getting, okay. Guys, in estimating R, now the formula, it's not particularly difficult. I think the one that's tricky is going to be the H model. I personally think that's probably one you want to commit to memory, because you're not going to try and derive it in the exam. The rest of the stuff is quite easy, so it's not too difficult. They just ask you to calculate. Okay, spreadsheet modeling, you guys can read through that, that's not particularly difficult. And then going on to sustainable growth rate, and this is extremely important, okay, because the way they can ask this in exam is in a variety of ways. They don't need to. They're not going to ask you to directly work out this. They're going to assume that you know that you need to do this. Okay, so ROE is equal to net income divided by equity. Okay, we know that formula. That's not a particularly difficult formula. That's your return on equity. Okay. More important around that is if you start to break, and you guys should have done this in level 1 anyway, the 3-part DuPont or the 5-part DuPont. So net income over sales, sales over assets, assets over equity. Okay. Depending on how those things change, that'll influence your ROE. Now, the extended formula for calculating growth, the only difference here is that net income minus dividends divided by net income. Okay. What does that give you? Net income minus dividends. The retention ratio. The retention ratio times your ROE gives you your sustainable growth rate. And that is where the formula is. So growth is equal to retention ratio times ROE. So if you can so the big thing about reinvestment, if you can reinvest your cash at a higher return than your R, then you would keep on doing it the whole time. If your return on equity is below your R, you're not going to retain your capital. You're going to pay out as much excess cash as you potentially can due to the fact that you don't have a good home for it to grow. Okay, if you're rational. Okay, and that's the stuff here. You guys know that. That's not particularly difficult, and that is it. Okay.